Hello, my name is Thomas Key and I am President and CEO of Stock Traders Daily. This presentation is about our sentiment table. Our sentiment table is something that we've been using for a very long time, but this presentation helps you understand just how proficient and profitable the alerts from our sentiment table can be. As of August 5th, 2015, our sentiment table was up 38% year-to-date on 9 trades. I'll tell you exactly how I derived those numbers. It was also in cash about 73% of the time. This is a contrarian indicator offered to clients of Stock Traders Daily. First of all, our sentiment table is a relatively simple indicator. We're looking for extremes. We either want to find conditions where everyone is positive or conditions where everyone is negative. It's relatively simple. And when we find those, we expect to see overbought or oversold conditions accordingly. If everyone is extremely excited, clearly we'd expect an overbought condition with a probable downside move to follow. And if everyone is pessimistic, oversold conditions with a probable upside move to follow. So it's a contrarian indicator. And the objective not only is to identify these overbought and oversold conditions and use them as contrarian indicators for short-term gains, but we also want to do it using ETFs, and this is the basis for the performance. Our duration, 2 weeks or less. We're not looking for long-term positions here. They're short-term positions, and direction of the market doesn't matter. The market can move up or it can move down, but because we integrate ETFs, some of them being short-based ETFs, we can actually buy short using those ETFs. The sentiment table is something that we've been offering to clients on Stock Traders Daily for about 7 years. It's something that has a long history, and I hope you appreciate it. There's a table dedicated to the sentiment table on our website. The web page can be found in our Utilities tab. And this is a closer look at what the sentiment table is. The sentiment table is just a list of stocks, basically, separated into weak, neutral, and strong columns on a near-term, mid-term, and long-term basis. Currently, we have 139 stocks in our focus list. This is a focus list that's time-tested. I've put it together over the years, and it's designed to include stocks that are likely to move with the market that offer representation of the market. Now, we follow 4 markets at Stock Traders Daily. We follow the NASDAQ, the S&P 500, the Dow Jones Industrial Average, and the Russell 2000. These stocks are mostly larger cap, so not so representative of the Russell 2000, I would say. The stocks in our focus list, that is. But it's important to recognize that all of the markets do play a role here. Now, when we're looking for overbought or oversold conditions in our sentiment table, there's really only one row that matters, and that's the near-term row. Remember, we're looking for near-term moves, not longer-term moves and not mid-term moves, but near-term moves. So all that matters is the near-term row. When you look at it, discount, mid, and long. When we look at the near-term row, in addition, all that really matters are the weak column and the strong column, respectively. The neutral column really doesn't matter to us. What we want to see are most stocks in the weak column or are most stocks in the strong column, and if that condition exists, then we will have either an oversold or an overbought condition, respectively. So it's the near-term weak and near-term strong columns that matter most to us. And the rule of thumb is as follows. If there are 100 or more stocks in the near-term strong column, then the likelihood of a turn down or an overbought condition that will be followed by a turn down exists. I put a upside down happy face, if you will, in this particular section because it's signaling that a turn down would follow after an overbought condition would exist. If 100 or more stocks are in the near-term strong column, that would be our assumption. In a relatively short period of time, that is. The opposite would be true if 100 or more stocks were near-term weak. If 100 or more of the stocks were near-term weak, we would expect the market to turn higher in the relatively near future, thus presenting an oversold condition and an actionable strategy. Think about what those actionable strategies would be. If it's strong, overbought, and we expect declines, we would buy the short-based ETF. If it's weak, we would expect the market to turn higher soon, so we would buy the long ETF for the market instead. So let's look at this table again, and you can see that this particular example, which by the way was from Sunday, just a few days ago, and the market turned down, by the way, from this overbought condition. But notice, 100 stocks were in near-term strong. That was an overbought condition in the sentiment table. This other stuff doesn't matter, right? It really doesn't matter to this particular use of the sentiment table. It matters for other things. And yes, we have a help tab on our screen in Stock Traders Daily that'll explain how to use it in other ways. But for this near-term contrarian indicator with the performance metrics I've shared, all that we're looking for are near-term weak and near-term strong indicators. And this example shows you what a near-term strong or overbought indicator looks like. So let's revisit that focus, right? We're looking for near-term only. If 100 or more are in the weak column, then that means that we would expect an oversold condition to exist. If 100 or more are in the strong column, we would expect an overbought condition to exist, which then would prompt action. Now, the sentiment table, yes, it's on our Utilities tab, but I also put it on the lower right-hand corner of our home page, so it's very easy for you to see. Anytime you go to the members' home page and you log in, you'll see the sentiment table on the bottom, so you can just glance at it to see if there's an oversold or overbought condition that exists in the market at that particular time. I also send emails, though, and this is our email archives, and this is where I derived the performance from, by the way. I just took it from the email archives. In the email archives, I'll tell you if there is an overbought or an oversold condition that exists in the sentiment table. So you can also go in the email archives, by the way, and see this. But when I do that, that's a signal to take action, right? And I usually do that the day before, not during market hours, so the day before. So it's very easy to identify. So the conditions for this performance metric are that an oversold or overbought email notice had to be sent, and that subsequently either that condition shifted from, say, overbought to oversold. If the initial email was overbought and it shifted to oversold, that notice would then have triggered an email and signaled to close that position. Either the condition shifted or our 2-week trade limit duration was reached. So either the condition shifted or the duration was reached. Those are our sell signals for this. And based on the email alerts and those conditions, using the NASDAQ, by the way, I use the NASDAQ for this observation. I like trading the NASDAQ. I think it's an efficient market. I think also the QID and QLD instruments that go along with it are efficient. But you can use any market if you want. This is NASDAQ-based, NASDAQ performance-based. But as you can see here, there were just 9 trades, 9 alerts offered all year. Giving you an example, we had an overbought condition late in December. It was reiterated on 12/23, but 12/19 it was initiated. From there, the market fell by 180 points and realized a 3.8% return on the short side within 14 days, as I've demonstrated here. On January 6th, we had an oversold condition, and the market rallied by 150 points by January 13th, returning 3.7%. I'm going to quantify this so we don't have to go through each one of them, but you can see this clearly in the email archives. Here's the way they look in an easier to read format. There were overbought and oversold conditions that happened regularly until after the first quarter, we'll say. And then there were all oversold conditions. Right? If you look at this closely, you'll be able to determine something that's interesting. But let's just start by saying that the durations are identified, the percentage returns are identified, and the condition overbought or oversold are identified. I'm going to point out the interesting things in just a minute. Let's start by identifying that there were only 9 trades. 6 of them were long, and 3 of them were short. 6 long means that there were oversold conditions, and 3 short means that there were overbought conditions. But remember, we're buying short, we're never outright short. The interesting part about this, at least my point of view, is the duration. Look, there's only 58 days when this was actually invested. That means something to somebody who doesn't want to stay invested all the time. In addition, the return, the net cumulative return of about 17% on 9 trades, I don't know anyone that's really going to complain much about that. That's not bad. But that's not the interesting thing that I really wanted to point out. What I really wanted to point out is that early in the year, anyone who follows this market regularly knows that there was more volatility early in the year, more profit potential from trading strategies early in the year. And as the year continued, there was sort of a malaise. It started by not really doing much, and then there were really no triggers from this particular trading indicator because the market was sort of stuck. Look, between 3.3 and 6.3, no indicators for 3 months. So when the market is moving and offering overbought or oversold conditions, it's also, in theory, offering trading opportunities or signals that opportunities are going to come. So in markets that are kind of flat or not moving anywhere, we don't get those signals from this sentiment table. It's important to recognize that it's giving you signals when profitable conditions exist, and it's not giving you signals when profitable conditions are harder to come by. That's important because that's controlling the amount of effort you put into this business. Let's take a look at just how valuable that is. Well, what's 58 days? 58 days is 27% of the time. You're not invested all the time in this market using this approach. It would only be 27% of the time. And, like I said, if the market's not moving, this is going to be neutral in cash and not offering overbought or oversold conditions. That's a huge added value. So, quantifying this, we have 9 trades for about 17% return using one-time ETFs. This is a market-based return metric. And it's in cash 73% of the time. That's nice. However, like I alluded to earlier, we like using the double-weighted ETFs. In the NASDAQ, that's QID and QLD. In the S&P 500, it's SDS and SSO. In the Russell 2000, it's TWM and UWM. And in the Dow Jones Industrial Average, it's DXD and DDM. We use two-time trading ETFs at Stock Traders Daily primarily. So in this example for the NASDAQ, we're doing QID and QLD. And here's the return. The red line is one time, and the green line is 2 times. We're approaching 40% using those double-weighted ETFs. 9 trades, 38%, and in cash, 73% of the time. I don't know anybody that's going to complain much about that. But there is a challenge here, and it's an important one. And that is you must be patient. Overbought or oversold conditions have come only 1.2 times per month on average. But remember, there was a 3-month period that there were no alerts at all. In fact, there were drawdowns at the end of March. So if you started looking at this at the end of March and you didn't get a profitable trading signal until June, hey, you could have said, what have you done for me lately? Over and over and over again. And if you did that and you were impatient, you didn't get the results of the strategy. In fact, over time, people tend to give up if they don't get something immediately. And so patience is a big deal. You must be patient if you want this to work for you. And that's the challenge. You must be patient. It works for people that are. There's also a catch here. And the catch is you must be a member of Stock Traders Daily. That's because you have to monitor the sentiment table in order to identify overbought or oversold conditions. You don't necessarily need to do that. I also send emails out to our members, so you can just monitor the emails too and look for the sentiment table emails. That's fine as well. But the catch is you have to be a member of Stock Traders Daily. Otherwise, you're not going to get the alerts. And to entice you to do that, and to influence you to be patient and let it work, I'm going to give all Platinum subscribers one-on-one assistance and our boot camp for free. The Platinum subscription, unlike the other subscriptions, is a 50% discount per subscription, but it's also an annual subscription. That means that you don't come in for a week and decide, oh, I didn't get a trading trigger, and you leave. Instead, you're going to be around for a year. In other words, you're going to put patience on the table and hopefully adhere to being patient as you wait for these sentiment table indicators to surface. I'm going to personally help you, make sure that you understand what the alerts are, how they are derived, what they mean to you, and what action you should take. And again, if you upgraded the Platinum subscription, I'll give you the boot camp for free in addition. The sentiment table is an extremely powerful tool. It works extremely well, and we've been doing it for a long time, but you need to be patient in order to take advantage of it. If you were patient this year, 38%, 9 trades, and in cash 73% of the time, it's just not a bad metric. And I hope you'd appreciated it. I think you probably would have. So let's get going. I look forward to having you as a Platinum subscriber. Let me know if you have any questions. Thank you very much.